2 steps forward and 1 step back. So far, that's an accurate description of reopening efforts in many states. Will the trend continue? If so, how long can the economy endure? It's that time again, time to tune out the hype and focus on the facts. Yes, facts that matter to you, the income generation. Let's get started. Get ready to separate reality from myth.
With us, David Scranton.
David Scranton.
David Scranton.
David Scranton.
But David Scranton says, hey, not so fast.
How does it affect the markets? How does it affect the economy? Thanks to efficiencies in new technology and a staff of veteran analysts and portfolio managers, Sound Income Strategy strives to set new standards and bring institutional style investing to your portfolio. Well, after 2 months of lockdown, by May 20th, the United States had begun lifting all these stay-at-home orders and other restrictions that were in place to contain the spread of COVID-19. Before then, new cases, hospitalizations, and deaths had declined, although there was no consensus among analysts that the infection curve had been successfully flattened. For a couple of weeks, the number of new cases reported daily remained steady at around 20,000 or so in the United States. But throughout June and into July, that number has steadily risen. This has been true particularly in those states that were quickest to abandon rules around masks, social distancing, and other measures. And as a result, many of those states have been forced to roll back reopening efforts, while even less impacted states have paused their reopenings as a precaution. So where does that leave us? What might it mean for financial markets, an economy already pummeled by this once-in-a-century crisis? We'll explore these questions and more right here on today's show, and we'll talk to you about what you can do to help protect your own financial future as this crisis drags on. Joining us today will be Dr. Marc Faber, editor and publisher of the Gloom, Boom, and Doom Report, available at gloomboomdoom.com, along with my co-host, Jeff Small. But before we bring out Jeff, let's take a quick look at where we stand with this reopening and how we got here. By late May, all 50 states had begun to reopen in some way, shape, or form after approximately 2 months of closures and quarantines for everything except essential workers and businesses. At the height of the restrictions, more than 310 million Americans were under directives ranging from shelter in place to stay at home. The orders varied across the country because governors were given wide discretion based on how the virus was impacting their particular state. That same policy has applied to the reopening, with governors proceeding at all different speeds, using different rules, and focused on different economic sectors. Among the sectors typically open first in most states were personal care services, things like spas, salons, barbershops. In some cases, then getting into things like gyms, health clubs facilities, other recreation facilities, and churches. Bars and restaurants, which have been hit particularly hard by the crisis, were also allowed to open in limited capacities. Typically, outdoor dining was first allowed, followed by, a few weeks later, by indoor dining, but only with limited seating. By late June, some states had reopened every major economic sector, at least to some degree, although most were still under restrictions. These included allowing fewer customers, or requiring masks, or enforcing social distancing. From the start, many health officials warned against moving too quickly and too aggressively with the reopening. Their concerns increased, of course, as images began to emerge of crowded beaches, shopping centers, and other large gatherings where people were clearly not wearing masks or social distancing. Soon after weeks of new case counts holding at about 20,000 per day in this country, the numbers in several states began to spike. Florida, Arizona, California saw some of the biggest jumps, along with Tennessee and the Carolinas. In Texas, just 55 days after beginning its reopening, Governor Greg Abbott ordered the next phase stopped as new cases and hospitalizations soared. Other states have taken similar actions, including some, such as Connecticut, whose case numbers have continued to decline since the reopening. On July 7th, the U.S. reported a record 60,000 new coronavirus cases in one day. That record was topped just a couple days later with over 63,000 new cases in a day. So what does all this mean for the reopening? What does it mean for the job market? What does it mean for the economy and the markets moving forward? We'll be talking about that coming up in just a bit right here on The Income Generation. Right now, it's time to welcome my good friend and co-host, Jeff Small, president of Faber Financial Services, a retirement income store in Melbourne, Florida. He's also the brand ambassador of the Retirement Income Store and Amazon best-selling author of the book, Turning Financial Planning Right Side Up. So, Jeff, I had a first this past week. You want to know what that is?
Sure.
First visit to a restaurant since the whole COVID-19 outbreak. I haven't done it. I haven't gotten takeout food. I haven't felt comfortable, but I had an older friend in town. When I say an old friend, a friend for a while, but also a friend who's a little bit up there in years. So once a year when he gets in town, I always want to meet up with him. And we went away, and I had this crazy experience. You know, it's maybe some of you can relate to this who are watching or listening. You know, you go to the restaurant, you have to wear this mask, right? And then you walk in and you sit down, then you take the mask off. And anybody who walks by you to their table, they still have to have the mask on, but yours is off. You're supposedly sitting 6 feet apart, but that's not quite true all the time. And then to make it worse, Jeff, get this. You know, as men our age sometimes have to do, right? You're waiting for dinner. It takes a little while, so you have to go to the men's room, okay? So you get up, you walk to the men's room, and there's a line outside because they only let one person in at a time. You have to stand 6 feet apart. So by the time you get through the queue in the restroom, you come back and your food's cold at the table. So I came with the conclusion that I don't think I want to go back out to a restaurant for a while. It's just not fun. It was a weird experience. I mean, have you done that yet?
Yeah, it's kind of creepy. Did you hold your breath when you went into the men's room?
Well, I usually hold my breath, yes. But having one person at a time makes it, in some ways, actually a little less dangerous.
Well, just so you don't inhale any of the corona, Dave. I mean, you know, because it is airborne. So, but I find myself, it's dumb, but you find yourself doing those types of protective things whenever you're out and about in the public and you see people that you don't know. But restaurants are a weird experience because you walk in with your mask, you take it off when you sit down and eat, and so it's a little awkward.
Yeah. I've seen, to me, I've seen a lot of that stuff. Even just, you walk around, you go to the store, and there's some 300-pound person sitting at the front door, making sure that only so many people go in at a time, and it's definitely weird. And I've got to think, some people who've been maybe a little lax about things now with these uptick in infections over the last few weeks, that maybe some of them might, start to take it more seriously, might start to. If we clamp down more, some of those people might be able to start taking my approach and just saying it's not worth it as much.
No, but we need, everybody should have a mask on if you're in public, period. I mean, you go to I went to the grocery store for the first time, Dave, about a week ago, and, this lady comes in, has a New Jersey housewives mentality with her sister and all of her kids, and none of them have masks on, and they're acting like everything's perfectly normal. And it's ridiculous. People need to be wearing masks. It's very inconsiderate not to have masks in public now, but there are people who refuse to wear them.
Yeah, and I'm not a big fan. Nobody is, but if I go out in public, you're right. Even just as a courtesy measure, you feel like you have to do that. And even you go to the gas station, and all of a sudden, if you don't have like a handy wipe or something around to put around that nozzle when you grab it to fill your tank, it's almost like you go into complete panic. I can't get gas today. I have to go get a handy wipe and come back. God forbid you're on fumes and you have a dilemma.
Well, the good news is they're not really worried about surfaces getting contaminated by the virus from surfaces, especially like a gas handle like that anymore, because we all were originally. We were all like, we go to the gas station and we're looking around, okay, who am I sitting next to, or who's pumping next to me, or who touched the pump before me? And so that's a concern. But you should have hand sanitizer with you, so before you get in the car, you can sanitize your hands.
True. So Jeff, I always love talking to you on the show here because I think our viewers get a couple different sides of things. And I'm like the worrywart. I'm like the nervous mom, right? So now I see infection rates going back up. The stock market seems to continue to go up. But I look at this and say, if states are unwilling to start to close down again and the infection rate really starts to get out of control, how long can the markets go up? Are we going to hit a tipping point with the stock market if this infection rate continues to go up? That's what keeps me awake these days, it seems. In fact, waking up at 2:30 yesterday morning and not being able to get back to sleep, thinking about that kind of thing.
Yeah, it's terrible that we have to think about that now, and that's part of our reality, and that has a really good chance of happening. I mean, look at the fall, Dave. You know, they're going to open up schools here in Florida. Florida's having an outbreak. And how many schools before if they have an outbreak in a particular school, like my daughter's school, if half the kids in one particular class get it, and it's all over the news, and then they realize they got to shut down the schools again. It's only going to take one or two massive infections in some school somewhere in a particular state for the state to say, look, we're going to close schools because now it can be contagious in schools as well, even though kids don't seem to get it as bad as people that are older. And so I think that's a huge concern. If that happens and we go through the shutdown scenario again, and it becomes a uniform shutdown as opposed to a, let's say, a blue versus red shutdown, because the red states are open, the blue states want to shut down. Maybe if there wasn't a political election in the fall, that wouldn't be the case. But if we go through a national shutdown, all bets are off in terms of what's going to happen with the market. The market's significantly overpriced without a shutdown at this point anyway.
Yeah, well, we'll see what happens with all that. It's all part of a vaccine and when it comes up. I am looking forward to talking to Dr. Marc Faber coming up in just a moment, though, because I want to ask him what he thinks about the markets moving forward. You know, you weren't there with me in March, but when I interviewed him, he was a little bearish, projecting a pretty significant pullback in the markets. Of course, that interview, I think, occurred right before all the stimulus came out. So it'll be interesting to see now whether he's come into the camp with the stock market, at least, of, don't fight the Fed. And I think if we can get Dr. Doom and Gloom to be optimistic about the markets, then maybe our income generation members will have something to be optimistic about themselves when it comes to their stock-based investments. So let's take a quick break, and we'll get back. And right after the break, we'll be back with Dr. Marc Faber and get his thoughts, as well as Jeff Small. Stay with us. We'll be back in a moment right here on the Income Generation. I'm David Scranton. As we reopen the economy, a renaissance has begun in the world of investing. If you or your advisor are not prepared for the new corona economy, you could be left behind. You don't have to cross your fingers and toes hoping for growth in this unpredictable stock market. There is a more conservative way, and that is to invest for income without all the stock market risk.
Call the Retirement Income Store today at 888-888-4176 for your free Retirement Income Kit. Call 888-888-4176 now.
Investing for income? The idea has grown in popularity over the last several years due to today's volatile stock market. But if you're at or near retirement age, it's no longer just how much you've saved. It's about maximizing and protecting your life savings while minimizing your risk from market ups and downs. David J. Scranton's new book, The Retirement Income Story, is here to help baby boomers face the challenges of investing in this age of economic uncertainty. Visit theretirementincomestory.com to learn more.
For behind-the-scenes photos, retirement planning tips, and upcoming giveaways, follow the Income Generation Show on Facebook. And don't forget to subscribe to our YouTube channel to watch video clips, guest interviews, and to catch up on past episodes.
As states start, stop, and restart their opening efforts in response to this crisis, the effect on employment numbers will continue to be as confusing as uncertain as everything else. Job reports from the U.S. Department of Labor were better than expected for both May and June, although the unemployment rate remains historically high. Now, while weekless jobless claims have decelerated since the beginning, the reopening itself, the reality is that nearly 50 million Americans at some point have filed for unemployment benefits over the last 4 months, which at least at one point at the peak wiped out the 20 million jobs added to the U.S. economy over the last decade by more than a 2-to-1 margin. Now, while some states have seen unemployment applications drop from the record highs in March and April, others have maintained very high job loss numbers. Not surprisingly, data from the Labor Department shows that states with the shakiest job numbers right now are also the ones seeing the most worrying rises in coronavirus cases. A comparison of each state's average weekly unemployment claim totals over the past 8 weeks, when compared to the 8 weeks following March 14th, shows that Texas, Florida, California, and Arizona have all seen their job market recoveries weaken. States on the other side of the virus spectrum, like Maine, for example, showed a noticeable drop in unemployment claims as their economies reopened, and this according to an analyst at Yahoo Finance. This analysis seems to support the idea that the states showing the most dampened recoveries are also the ones that are dealing with recent and significant spikes in coronavirus cases. Even without the hard numbers to back it up, that idea seems logical. It would also seem to support the remarks made by Fed Reserve Chairman Jerome Powell in his recent testimony to the House Financial Services Committee, where he said the path forward to the economy remains extraordinarily uncertain and will depend in large part on our success in containing the virus. And again, this said by Chairman Powell. He went on then to say a full recovery is unlikely to occur until people are confident it's safe to engage in a broad number of activities. Now, naturally, that level of confidence is unlikely until the virus is truly fully contained, which it clearly isn't. So will a vaccine help? If so, can the Fed continue keeping the stock market propped up until one arrives? We'll talk more about that coming up in just a bit. Right now, it's time to bring back in my good friend and co-host, Jeff Small, as well as a good friend of the income generation, Dr. Marc Faber, editor and publisher of the Gloom, Boom, and Doom Report, available on gloomboomdoom.com. Dr. Faber, thanks for being back with us today.
It's my pleasure. Thank you very much.
You know, I have so much to talk to you about. You were here back with us 4 months ago, literally at the bottom of the stock market, literally at the very possibly the worst day. So we want to talk to you a lot today about first the economy, then the stock market, and then the Fed. And we want to see what's changed since last time. So first, the economy. We're about to get some economic numbers out over the next several weeks between corporate America, between second quarter GDP shrinkage and everything. You thought they were going to be pretty gloom back then, but how do you think they're looking now after living through this partial reopening? Do you think that they're going to be a little better than maybe you initially thought, or even worse?
No, I think the real economy the figures are going to be bad, but they're going to be good compared to what they were, say, 6 weeks ago or 2 months ago. You understand? We fell off a cliff, and like a tennis ball, we're rebounding. We're in this rebound, but it's still going to be lower than a year ago. And in some industries, much lower than a year ago. Say airline traffic may rebound by 100% from the low, but then it's still down 70% from a year ago. So these are the kind of figures you can anticipate.
Yeah. Well, I know one of the things you said too is that the economy was already starting to turn 18 months before this crisis. So this just expedited it. What's your best guess? I mean, if I, you've been on the show several times here, so allow me to just push you just a little bit. If you had to guess what the number would be for a percentage GDP drop in the second quarter, is it going to be like the minus 35 or 40% that Morgan Stanley, Goldman Sachs predicted? Well, what if you had to pick a number? What's your best guess second quarter?
It will be lower than a year ago. Exactly what it will be will depend on who publishes the statistics. You understand? It's like the votes. It depends who counts them. And one thing that has happened that wasn't the case when the stock market hit the low on March 23 was that we have had huge stimulus packages. And this stimulus has kept incomes at a relatively high level. So exactly what the figures will look like, I think to make a guess, I suppose GDP will be down 15 to 20% maximum, what they will report. But you have to understand, people don't eat by GDP. We had this huge stimulus. We had also huge liquidity injections, and the liquidity injections have been very good for Jeff Bezos and the Netflix and the Apples and the Zoom of this world. but they haven't been good for the mom and pop shops. They've been very good for the Robin Hood trading platform and for speculation in stocks, not just in the US, globally. There's a huge mania in stock buying and selling, day trading.
I know, and it's interesting. So you're actually thinking pure GDP. It's not going to affect a lot of America, but pure GDP second quarter, when it finally comes out next month, the report won't be quite as bad as Morgan Stanley and Goldman Sachs had predicted.
Yes, I don't think it will be that bad.
But I want to turn it over to Jeff to ask you about how that affects the stock market, because I know Jeff's chomping at the bit to talk to you about the market. Jeff?
Yeah, Dr. Faber, I was listening to one of the Federal Reserve bankers yesterday on CNBC, and I won't mention him by name, but he said something really alarming to me. He said he doesn't see the economy converging into stock market values for years. And that gives me the idea that they're going to have stimulus upon stimulus upon stimulus. And as we reach these new epic values in the market, it seems completely disconnected. I mean, do you see a time when the economy may converge into stock market values? Because right now they're disconnected.
And Dr. Faber, just so you know, we only have 1 minute left in this segment, so go ahead.
Yes. Okay, the Fed monetizes debt. They also bought junk bonds. So the stock market has rebounded very strongly. And I think the stock market may continue to go up because of money printing. In other words, not for the right reason. It's no longer an economy where the real economy, what you and I do every day, has an influence on the stock market. It's a stock market that has an influence on business. And this is the essentially situation we're in.
Okay, all right. Interesting. Well, we need to take a commercial break, and when we come back, I want to talk to you more about the stock market and want to talk to you about the Fed. So if you stay with us, Dr. Faber, that'd be great. And you stay with us too. We have much more to come here on the income generation in just a moment. We'll be right back. Hi, I'm David Scranton. As we reopen America during these difficult times, we're all practicing social distancing. But at the Retirement Income Store, we're also practicing stock market distancing. You don't have to cross your fingers and toes hoping for growth in this unpredictable market. There is a more conservative way, and that's to invest for income without all the stock market risk.
Call the Retirement Income Store today at 888-888-4176 for your free Retirement Income Kit. Call 888-888-4176 now.
Here's the reality. New outbreaks of COVID-19 were inevitable as states reopened their economies. In fact, I made this point 3 to 4 months ago right here on the show. In fact, it's simple exponential math. You start with $1, you double it, you get 2, and then double it again to 4, and then 8, 16, all the way up to 128. Now, you take away 127 and start with $1 again. Guess what? The same thing builds up all over again. And that's why failing to eliminate the virus completely made new outbreaks inevitable once reopening began and people started gathering. This isn't to say I believe we should have waited until cases were down to 0 before moving forward. That would be, in some ways, impossible. However, evidence suggests we can better control the severity of new outbreaks by staying diligent and using the right strategies for reopening. Some states are demonstrating this while others are learning it the hard way. And unfortunately, until all states have learned it and have begun to push the numbers in the right direction again, the consumer confidence needed for a full economic recovery, as Chairman Powell discussed, probably won't be there. A vaccine might help that situation, and the news on that front is encouraging. A German biotech company has been working on a vaccine with Pfizer. The company's CEO recently said he's confident they'll be ready to seek approval for widespread distribution by the end of the year. An effective vaccine would obviously help build the immunity needed to end the pandemic. However, remember that some vaccines are more effective than others. For example, last year's flu vaccine had just a 40% effectiveness against you catching the flu. So the question becomes, would a 40% effective rate for COVID-19, would that vaccine really be enough to make you feel comfortable going out? Probably not. If it were 99%, 95% perhaps, but probably not 40%. So therefore it means it probably would not be enough to build the confidence needed for businesses to get back to full capacity and to lead us to full economic recovery. Possibly, but probably not. What are the implications for financial markets in the meantime? We'll be talking about that coming up in just a moment. Now let's bring back my co-host Jeff Small, along with Dr. Marc Faber, editor and publisher of the Gloom, Boom, and Doom Report, available on gloomboomdoom.com. So Dr. Faber, I know you're trying to be good there before in answering Jeff's question and trying to do it in time because we had to take a commercial break. But I have a feeling there was a little more you wanted to say there. Am I correct?
Yes, especially Jeff asked or made the comment that in his opinion, the diverging performance of the real economy and the stock market would mean that there would be continuous stimulus packages into the future. When the Fed first began with QE1 in December 2008, my view would be that there would be QE infinity forever. Once you start printing money, it's very difficult to stop it. And secondly, once you start with handing out money, as was done, and at the same time, many states are still essentially under lockdown, what will happen is that paradoxically, under a Republican president, they introduced basic income. I think the basic income will continue because at the present time, and this is very dangerous in my opinion, there are so many academics that claim that debts don't matter. Debts don't matter now because interest rates are next to zero. But if one day interest rates go up, it could end up in a gigantic mess.
Yeah. I know you said that last time, too, that you were concerned about that. What's interesting, the changes, I think we might have interviewed you literally one day before the Fed came out with the big package. They lowered Fed funds rates to zero. So you were thinking the market was going to be down 50, maybe even 70%. And then obviously, literally a day or two later, I think the Fed tried to make a liar out of you. But Jeff, I know you wanted to ask more about the stock market too, so go ahead.
Yeah, I guess, Dr. Faber, the valuations and are really ridiculous. You mentioned Facebook, Amazon, Netflix. They all got a big boost. And so now we're at this new market plateau. We're 4% below the market peak we were on February 7th before the virus really took hold of the markets and put the fear of panic selling in the markets. And so at this point, though, when we look at things like the Buffett indicator, which is a simple ratio of the market cap as a ratio to GDP, it's going to be in the 190th percentile. That's the biggest it's ever been. I mean, this market value is really scaring me. Do you see a correction coming because of these values being too high at this time?
Well, first of all, I have to correct one point. On March 17th, I sent out a tweet that the stock market was grossly oversold and that it would rally. So it's not that I said that near the market lows it would fall another 70%. But basically, on valuations, traditional valuation measures, it should probably be down very substantially. However, we have to be more nuanced. The stock market is driven by very few stocks. So if you look at the list of new highs, it's very narrow. There's just, say 20 stocks that are driving the indices higher. the semiconductor stocks, the FANG and related stocks, Tesla and so forth, they go into the sky. But then you have many markets, also especially foreign markets, that are depressed. They've been in bear markets since 2015. So this is where the value emerges, in my opinion, and where the markets, what you could have is essentially the FANG stocks coming down or no longer going up, and value stocks, including oil and resources and gold and banks going up. So this is a possibility. The one thing I believe is that the Fed, and that I said a long time ago already, that the Fed will not tolerate a 20% decline in asset prices. They will support asset prices because they're already so deep in ST. So they can't give up. Number two, what you said about the packages, I think, you know, as you know, there is a bickering between the Democrats and the Republicans and so forth. And the Democrats want to essentially prevent Trump from winning a second term. But it is inevitable that they will have more stimulus packages. You can't stop giving out money on July 31st. Otherwise, the whole economy collapses overnight.
Well, no, you're right. I mean, even Nancy Pelosi said they want to reconvene Congress in August so they can work on another round of financing and stimulus from Congress. And so obviously it looks like it's going to happen again. You're right.
You're right. You got basically the basic income that came in from Congress, and then you have the Federal Reserve with QE affinity. So 30 seconds left, Dr. Faber. Our average income generation member over the age of 55 years old, what do they need to know? What do you want to tell them?
I think the biggest danger is that the current expansionary monetary and fiscal policies lead down the road to hyperinflation and the complete implosion in the value of paper money.
Well, I hate to leave it on that note, even though we have to. Perhaps we could talk a little bit about how to protect against that in the next segment, Jeff and myself. Dr. Faber, thanks so much for being with us today, as usual.
Well, thank you very much for having me.
And
Bye-bye.
you stay with us, too. We'll be back here with more. Jeff Small and David Scranton right here on The Income Generation. We'll be right back.
Diane and her husband dreamed of spending their retirement traveling, but that changed when she became her mother's primary caregiver. Now her day starts before 6 a.m., helping Mom often late into the night. It's a stressful job, but Diane wants the best for her mom. Sound familiar? We thought so too. Caregiving can take a toll on your family, but the Retirement Income Store is here to help. Call 1-888-888-4176 to find out how the Retirement Income Store can help you achieve financial empowerment during retirement.
Welcome back to The Income Generation. I'm David Scranton. I'm here with my good friend and co-host, Jeff Small. So, Jeff, there you have it. Dr. Gloom and Doom is actually not so gloom and doom, at least for the short or medium term. Actually saying that he thinks, I think he's following this don't fight the Fed thing, that, if the market drops 20%, the Fed will jump in with more stimulus and, the markets will come back up again. So a little surprising, or maybe pleasantly surprising, though, don't you think?
He really shocked me because I'm glad to see he was optimistic and he told the truth about stuff and he wasn't full of financial dogma and force feeding us like some other folks have that have been on the show. But I thought he did a really good job and he had a very modern perspective. So my hat's off to him. I give him a round of applause for what he said.
Okay. Now I interpreted that as just they're not going to do anything new. They're just going to continue with more of the same type of stimulus, be it more QE, whether it be more buying of bond ETFs and individual corporate bonds. Is that how you interpreted it?
That wasn't how I interpreted it. I saw that as financial code for the Fed is going to buy stocks next, because now they have unlimited capacity, right? So they plan on probably tripling their balance sheet, which is going to lift up asset prices, even if the economy declines worse than we expect. And so, then if we go into a sell-off for some reason because of COVID, then the expansion of COVID and potential shutdowns, I see the Fed coming in to buy stocks to alleviate the crash in the market, the same way they came and bought bonds to lift up the bond market. They're going to do the same thing for stocks, Steve, and I think that's what Dr. Faber meant.
Interesting. Yeah, I didn't take that away, but he could be thinking that, because I've said before I wouldn't be surprised, quite frankly, if the Fed starts buying stocks to prop up the stock market. It's happened in other countries. Wouldn't shock me at all. Everybody who seemed to have on the show seems to say we're not going to negative interest rates. Even Dr. Faber said that in my interview back in March. So if we're not going to negative interest rates, there still has to be some tool there. And I guess at the end of the day, although the Fed's mandate is not to prop up the stock market, there's that thing we always talk about, Jeff, called the wealth effect, right? Our listeners, our viewers, you sitting at home, when you all of a sudden see that your investments are going up, your 401ks are going up, you feel better, you feel wealthier, you're more apt to have confidence to go out and spend. Whereas if you see those things going down, all of a sudden you might think, oh, the heck with that, I don't want to spend. And all of a sudden it creates a recession. So I guess indirectly that's how they're trying to avoid get out of the recession or keep the recession from getting worse, right?
Well, yeah, the Fed's objective was to how do we get average investors and the rest of the investing world to start buying stocks again and come back to the market, because that's one of the ways they think they're going to lift us up out of the economic doldrums. Additionally, though, not only is the stock market rocket hot and the investors have been coming back in droves, the real estate market is also rocket hot, and people are buying real estate, and real estate's back at its maximums. Despite, Dave, 8% of all mortgages utilizing forbearance to avoid 2 or 3 months of payments since the March event of COVID. And so there's a balancing act there. Goldman Sachs has got $20 billion of collateralized loan obligations on their books, which are primarily mortgages. They're the biggest mortgage holder out there. And I think if you've got a big money in a big bank, you got to be careful today. Not that we're going to have a 2008 meltdown like we did in 2008 and 9, but I think you got to be careful today because of what the economy is giving us as a warning signal.
It's interesting. Dr. Faber was more positive than normal until the very end. The very end, he did that almost like that gold bug thing where he says, hey, I think the dollar, hyperinflation, the dollar is going to devalue and it's going to be worthless. And I don't see that. I just don't see enough. We've been fighting an aging population and a limiting demand for goods and services for years now. That's why the Fed, even with interest rates near zero, has been unable to create growth more than 2%. So I just can't imagine how all of a sudden we're going to have hyperinflation. I think we have this demographic trend that's going in the other direction.
Well, it's not just the demographic trend, it's the employment trend. And so now we're going to be going through a downsizing of the next 24 months in corporate America. We're going through a downsizing. Businesses are going to shut down because the restaurants down the street from us in our neighborhoods that we all live in are going to shut down because they can't survive in the environment. And a number of other businesses are going to be affected by that. So it's going to be almost impossible to create inflation. I mean, wasn't that what the Fed tried to do the last 10 years, Dave, or 11 years, was to create inflation, and they couldn't?
That's my point. And ultimately, if the dollar is going to fail, there's got to be other countries that are stronger that can take over as the world reserve currency. And we're not seeing that right now. And if all the currencies drop together, well, then we're all in the same boat and there is no inflation. So I agree with you. I don't think that's the big argument there, the valid argument. But when we come back, we're going to have some fun. And I want you to stay with us because when we come back, Jeff and I are going to talk about how to apply this information to your own hard-earned savings. And bottom line, what you need to know as a member of the income generation to protect yourself. Stay with us. We'll be right back in a moment on the income generation. Welcome back to the Income Generation. I'm David Scranton, and I'm here with Jeff Small. So Jeff, let's sum it up for our viewers and our listeners. It seems to me like, obviously we always talk about the first thing is make sure your income needs are satisfied if you're retired or within 10 years of retirement. And doing that through common stock is one way, but ideally not necessarily the best because, as we've learned recently, stocks can cut dividends. But once I've got my income needs set, then how do I safely invest in the market? What do I do? Because right now, everybody seems to be agreeing that the market's going up just because the Fed. So the whole bet is betting on the Fed. What if the Fed surprises us and goes the other way? How do we protect ourselves against that?
Well, I don't think the Fed is going to go the other way, but I think what could go the other way, Dave, is the COVID. The coronavirus could go the other way, as we're now in an exponential crisis as this thing decides to expand, and it's really not containable at this point unless we go draconian. I think that's what's got to happen probably to try and eradicate this, because I don't understand how China could have barely any virus infections, 20 a day or 10 a day or whatever, and we've got tens of thousands, over 50,000 a day as we march to 100,000. So that's what folks need to be concerned about, is what's going to happen with the virus. So Wall Street cares about two things, Dave. They care about the rate of hospitalizations, the daily rate of hospitalizations either trending up or down, but they really care about mortality. Is the mortality going up? And if the mortality goes up, that's going to rattle the markets. And so you've got to be very careful if you're an investor. You want to pay attention to that dynamic.
Yeah, I agree. And there's a lot of people, though, that want to be in the game. Yeah, they want their fixed income. They want to have upside potential, though, of the markets. But I think so. I think a few of the things they need to know are this. Number one, the mutual funds, the ETFs, the indexes, those are great through 2019. It's more of a stock picker's market right now, where professional money managers with individual stocks have an advantage. But even then, even having one figure on the trigger potentially, having stop losses, protecting with options, there's all kinds of strategies, that our viewers and our listeners can embark upon in order to still be in the game, get a little bit of upside potential in case everybody's right and we do continue with the QE, but to protect in case everybody's wrong. That's kind of how I'm looking at that. You see it any differently?
No, I think that is spot on. It's really important to know what works and what doesn't work in this environment, and you don't want to be a penny wise and a pound foolish and go for the gusto and expect the markets to keep going up. Because right now the market is, it makes absolutely the worst amount of sense that I've ever seen in my 35 years in this business. Fundamentals are detached, there's too much stimulus, and it's too risky for people that are over 55, Dave.
Yeah, well, I agree with you there for sure. So we need to take another break here. Stay with us. I'll be back in a moment with more as we wrap up the show. So stay with us. We'll be back in a moment on the Income Generation. I'd like to thank my guest, Dr. Marc Faber, as well as my good friend and co-host, Jeff Small, for joining me today here on the Income Generation. Most importantly, though, I want to thank you, our new and returning viewers. So recently, I dined in a restaurant for the first time since its reopening began. And I must admit it was a very strange experience. I was there with a friend. We both had to wear masks until we were seated. When we got seated, we were able to take the masks off. Our table was supposedly 6 feet apart from the others, but not quite. Our waitress wore a mask, and of course we had to put ours back on if we needed to go to the restroom. By the time we put the mask on, went to the restroom, and waited outside because they only allowed one person in at a time, I got back to the table, my meal was sitting there, it was already getting cold. Okay? And by the end of the evening, I actually realized, as much as I'm eager to support the local economies, local businesses, it'll probably be some time before I got to dinner again. And I'm sure some of you have had a similar experience. Here's my point. The significance of these rising COVID-19 numbers isn't just about the numbers themselves. It is about the psychological effect on the population as a whole, even if you're in a place where the numbers might be trending down as we speak. That's why Fed Chairman Jerome Powell was right to say, a full recovery is unlikely to occur until people are confident it's safe to engage in a broad range of activities. And that confidence just isn't possible as long as cases keep spiking, even if those spikes are confined to certain states and areas. So the big question for you as an investor is, as the situation continues, will the Fed be able to prevent another major stock market pullback? Or will Wall Street eventually have to accept a long, slow recovery from this crisis, a recovery that I initially thought was inevitable? An analogy I used recently to describe this situation is this. Imagine you have 3 rooms. In one room, you have the heat cranked and the door closed. Another one, you have the air conditioning cranked and you have the door closed. You're in the middle room, and you simultaneously open both doors. What's going to happen to the temperature in your room? Is it going to get hot or is it going to get cold? Well, there's no way of knowing. But doesn't it make sense to prepare for both possibilities? And that's what making the strategic shift from portfolio growth to retirement income does. It prepares you to not only help protect your assets from uncertainty now, but also take advantage of potential new opportunities in the future. As always, stay safe and thanks for watching. If you're retired or close to retirement and you're concerned about your money, it's absolutely essential that you stay informed and up to date. And as you know, right here is where you can do it on the Income Generation. I'm David Scranton, and we'll see you next week.